Well, good morning and welcome to the Unraveling the Mystery of 1031 Exchanges. My name is Bill Exeter, and I'm the President and CEO of Exeter 1031 Exchange Services and also Exeter Trust Company. I should also say good afternoon for those of you who are on the East Coast there. With that, let's go ahead and get started. First of all, a couple of housekeeping items. We have a lot of people on the call today, so in order to keep it moving and eliminate all the background noise and what have you, we're going to keep everybody in a listen-only mode. We do want to encourage questions. We want to take questions as we go through the webinar. So on your dashboard, you should have a question item. Just go ahead and type your questions in as they come up. We also have a lot of questions that were submitted before the webinar through the registration process. So I have a list of those here. We're going to try to cover those as we go through the program. Otherwise, we'll cover them at the end of the program. But please do ask questions as we go. If you just post them in the question box, we had a couple people who are watching the questions, and we'll make sure we get those covered for you. Also, if you can hear me fine, great. If you are having a hard time hearing me, please post it in the question function just so I know. I'm going to try to use a speakerphone today so I can use my hands on the computer and the questions and all of that. So with that, let's go ahead and get started here. A purpose of the webinar today is to unravel the mystery of 1031 exchanges. And we have found that people will call and say, I talked to 3 or 4 people and I feel like I got 3 or 4 different answers to my question and I'm really confused, so I need some help. And the reason for that is in the 1031 exchange world, there are lots of opinions out there. The tax code, the regulations, the rulings, court decisions, in a lot of cases, they leave a lot of questions unanswered. They leave a lot of stuff up in the air, and it creates a huge gray area for the industry. And when you call 3 or 4 companies or people, you tend to get 3 or 4 answers, and then people get confused. And they're not necessarily wrong answers, they're just different opinions. And so what we try to do through our program is unravel that mystery. We're going to try to point out why you get different answers and where they're coming from, and we want to point out the conservative versus the aggressive and the pros and the cons. And that way you can make your own decision based on what's right for you. So that's really the purpose, is we want to provide as much pure educational information to investors and their advisors so that you can make better informed investment decisions. That's really what it's all about. And so we try to treat our webinars more like workshops. You can roll up your sleeves, ask a lot of questions, and go from there. And then we're always welcome to talk to you afterwards if you, excuse me, if you want to brainstorm on any of the subjects. With that, let me quickly go into a quick introduction as to who we are. That way, if you've never worked with us before, you'll get a quick overview. Exeter 1031 Exchange Services serves as a qualified intermediary, and we administer all types of 1031 exchange transactions in all 50 states. We're also one of the few 1031 exchange companies that actually administers foreign property transactions, and we'll cover those. Just a quick note there, it does have to be foreign property exchanged for other foreign property. You can't exchange foreign property for U.S. property or U.S. property for foreign properties. So the 1031 exchange has to be either all United States properties, what we call domestic properties, or it has to be all foreign or non-domestic properties. You can't go back and forth. We administer all types of exchanges. That includes forward 1031 exchanges. That is about 97% of our volume. And forward exchanges means you're selling your relinquished property first, and then through the 1031 exchange, you're acquiring your replacement property later within the required timelines. We also administer reverse 1031 exchanges, and that's about 3% of our volume. And reverse 1031 exchanges means that you are buying your replacement property first and then selling your existing relinquished property later, also within the required timelines. We also administer improvement exchanges. There's not a whole lot of improvement exchanges done because of all the timelines, but there are a few. And improvement exchanges mean that you are selling relinquished property, you're exchanging into replacement property, and you also have leftover exchange funds that you want to use to build, construct, or retrofit the property that you've acquired. So you're improving your replacement property as part of the 1031 exchange so that all of the funds can be used and they're all tax deferred. So we focus on real property 1031 exchanges. For those of you who've been doing exchanges for quite a while, we used to be able to do 1031 exchanges on personal property. Personal property means anything that's not real estate. Things like aircraft, shipping, trucking, livestock, machinery, etc. The Tax Reform Act changed that, so effective January 1st, 2019, 1031 exchanges only apply to real property. Now, you can't do 1031 exchanges on personal property. And like I said before, we also do foreign property 1031 exchanges as well, and we'll talk a little more about that. The process for the foreign property 1031 exchange is really the same as a 1031 exchange of United States or domestic property, except that we have to navigate through the local laws, regulations, and customs for closing property in that particular country that you're working with. A little background on the experience of the company and me personally. Exeter 1031 is now in its 15th year, so we've been doing exchanges for a long time. I've personally administered over 125,000 exchanges during my 35-year career, so we've got a lot of experience in doing 1031 exchanges. We have seen a lot of strange exchanges over the years, so we've developed an expertise for the more complicated. So from my perspective, there's two most important things there. We have expertise and we have experience, which is critical. A lot of qualified intermediaries are more advisory are more processors in nature, and we're more advisory and consultative. So we really work with the investor and their advisors to really work through all the issues, review the documents, see if there's any concerns or issues that need to be brought up, and make sure that the investor is going down the right path. So we always have, we have the answers. If you have questions, please reach out and ask. We will help you out there. We also are the only exchange company that has 24/7 access, so you can always get access to one of our senior folks 24/7. We've actually rolled out a trust company. We took the decision, or made the decision a number of years ago, that we need to go to the next level and protect our clients even more than what we have in the past. So we decided to go down the regulatory approval process. We applied with the Wyoming Division of Banking to be licensed, regulated, and audited by them as a bank or a trust company. So we've got that charter now, which means that now Exeter Trust Company serves as trustee for the qualified trust account. So we'll talk more about what that means. But that really holds your 1031 exchange funds in separate, segregated, dual signature qualified trust accounts. That means that Exeter 1031 exchange, as the qualified intermediary, has to authorize any disbursements, but so do the investor. The investor also has to authorize along with Exeter 1031 before any disbursements will be made. So it adds additional protection to your funds there. We are actually one of the only qualified intermediaries that has any kind of government oversight, which is critical. Most of the failures we've seen over at least the 35 years I've been doing exchanges could have been prevented had there been government oversight, and less than 1% of qualified intermediaries have any kind of government oversight, so that's critical. And then a quick footnote, we also have another entity, a sister company called Exeter Asset Services Corporation. This is the entity that serves as the exchange accommodation title holder when we have to acquire and hold, or what the IRS refers to as park, legal title to real estate as part of a 1031 exchange. This would be either a reverse 1031 exchange or an improvement 1031 exchange when we have to hold legal title to the property. And then Exeter Asset Services Corporation sets up a separate segregated single member limited liability company for every single transaction. So that really means you're protected. We do not use the same entity over and over and over like some qualified intermediaries do. We set up a separate, brand new LLC for every single client for every single reverse exchange. The last thing you need is an entity that uses the same company over and over and over. At some point, there will be some kind of a lien or a judgment or something like that that will create problems for future clients. So we always set up separate and brand new LLCs for the client's transactions. We have some regional offices around the country as well, and they are on the lines with us today also. So I just quickly wanted to flash that up on the screen so that you can see those. Okay, before we get started on the 1031 exchange topic, I wanted to quickly go over some tax deferral strategies that could be appropriate. Generally, the 1031 exchange is the best strategy, but not always, so I want to quickly cover these. So the 1031 exchange applies to any property held for rental, investment, or business use, and we're going to dive a lot more deeper into that. It does not apply to a home, a primary residence. It has to be rental or investment property. It does not apply to a second home or a vacation home if they're used for personal use, although that can change. We'll go through that as well. The second one is a 1033 exchange, and most companies who make presentations don't bring this up, but I bring it up because I think it's an important element in your planning, in the strategic planning, because you may be selling property and the buyer or potential buyer could be some type of government entity that has eminent domain authority. And with eminent domain, that means they're taking your property or they're threatening to take your property for some type of public benefit. A lot of people refer to it as a condemnation, but it's really an eminent domain action or proceeding. And the reason I bring it up is it's actually a great transaction strategy for you. So if you are selling property to a government entity, you may want to ask them to threaten you with eminent domain proceedings. That's probably one of the few areas we want the government to actually threaten us. But what happens is in a 1033 exchange, one of two scenarios apply. One is it could be a natural disaster, fire, flood, hurricane, mudslide, tornado, etc. The government declares it as a natural disaster area, and you could do a 1033 exchange. Your property is partially or completely destroyed through the natural disaster. You file an insurance claim, you get a claim check. The claim check is technically treated like sale proceeds for the property. Now, most people take those proceeds and reinvest right into the property. That's considered a 1033 exchange. You're reinvesting in replacement property through the repairs and maintenance and rebuilding on the property. So we don't really focus on the natural disaster area, but I just wanted to mention that. We focus on the eminent domain side of the 1033 exchange because you might be able to ask the government to threaten you. All they have to do is build it into the contract or send you a letter that says, if you fail to sell this property to us, if you fail to close, we will take the property through eminent domain. It can't be maybe, it has to be a legitimate threat. So they have to say, if you can't do this, if you can't close, etc., we will take the property. And that threat is enough to qualify for 1033 exchange treatment. With that, you have a longer time frame to reinvest in replacement property. So you have more time to plan and look for property and do your due diligence. And my favorite part of the 1033 exchange is you can actually pull cash out. In fact, you could buy your replacement property for 100% debt if you could pull that off and keep all the cash, and that would not be a taxable event. That's unlike the 1031 exchange, where if you end up with cash left over, it is taxable. With the 1033, you can pull cash out, it is not taxable. The challenge with the 1033 is the definition of like-kind property is a little narrower for an eminent domain, and it's a lot narrower for a natural disaster. So some folks will still opt to do a 1031 exchange anyways, just to get the broader definition of like-kind property. Okay, jumping down to the next one, the 1034 exchange was repealed in 1997, actually 1996, and the 121 exclusion, or section 121 of the tax code, was placed in service January 1st, 1997. So the 121 exclusion is actually a better mousetrap, but I wanted to kind of point out the differences. There's still a lot of folks that think if you sell your home, your primary residence, and reinvest in another primary residence of equal or greater value, that you defer the taxable gain. That's the 1034 exchange, and that no longer exists. We don't have that 2-year window where we can roll over the gain. What we have today is the 121 exclusion. And the way that works is if you've got a primary residence and you own it and you can say you've lived in it as a primary residence for at least 24 months in total out of the last 60 months, so 2 out of the last 5 years, then you get $250,000 of taxable gain, tax-free if you're single, $500,000 tax-free if you're married. So tax-free is always better than tax-deferred. So it's a better mousetrap, unless you live in an area where you have highly appreciated real estate and your gain is over the 250, over the 500,000. Then you'd get the first 250 or 500 tax-free. Everything above that would be taxable. There are ways to address that issue, and we'll talk about that toward the end of the webinar today. So you can combine a 1031 exchange with a 121 exclusion. We'll show you how. The next one is a 721 exchange. There's not a whole lot of these out there, but we wanted to quickly mention it to you. This is actually a 2-step process in most cases. It's a 1031 exchange up front and a 721 contribution at the back end. So from a step-by-step perspective, what happens is you sell your current property, you structure a 1031 exchange, but instead of going out and finding your own property, you identify a fractional interest or a percentage interest in property that a REIT, a real estate investment trust, is putting together, and you actually buy a small percentage interest in that property. That's the first part. You close on that, and you're going to be a tenant in common with a lot of other people on that property, and you'll hold it as a tenant in common for anywhere from 1 to 2 years to show that you intended to buy and hold as an investment. And then after that holding period, then the 721 contribution kicks in. That entire property with all the investors is contributed into a partnership that's owned or controlled by the real estate investment trust, or the REIT. And that's the UPREIT. The umbrella partnership is the UP and UPREIT. So in most cases, clients will call and say, I'm selling, I'm going to do an exchange, I want to buy a REIT. Does that qualify? And typically the answer is no. The REIT is a security. So that doesn't qualify as like-kind property. You're selling real estate, you have to buy real estate, and shares in a REIT is not considered to be real property. The UPREIT is the one exception to that, where you go through that process that I just described. And with the next one, the section 453, that's the installment sales section of the tax code, or what people refer to as a seller carryback note or seller financing. We're going to talk more about that, but effectively, if you're selling property and the buyer asks you to hold a note, to carry back papers, you decide, yes, I'll help you finance the property and I'll do a seller carryback note, then that allows you to sell the property, help the buyer finance it. However, you're getting some cash and you're getting a note, a promissory note that the buyer is going to pay over time. That allows you to defer some of your taxable gain over the term of the note, and it also will recognize some of the taxable gain up front. So it is a way to defer your capital gain tax over a period of time, but it is triggered, and then you just recognize the tax as the principal payments are made throughout that process. It's also possible to include that seller carryback note inside of the 1031 exchange, but it complicates the 1031 exchange process, and we'll get into more detail at the back end of this program. So the walk away from this slide is there's a lot of options. It's always critical to seek legal, tax, and financial counsel to make sure you're going down the right path. And I know a lot of people just go, I don't want to spend the money, etc. But quickly meeting with your tax advisor is really important for many reasons. One is, should you do a 1031 exchange? Should you do some other type of tax planning strategy? Maybe you don't need to do any type of exchange or tax planning strategy at all. Maybe you have other items on your tax return that could offset the gain. There's a lot of reasons why you may not want to do some of these strategies. So again, you don't know what you don't know until you sit down with your advisors and really know what you're facing at that point in time. Then once you see your taxable gain or taxable loss, etc., in black and white, then you can make a decision on what's best for you. Okay, let's move on. We're going to now focus on 1031 exchanges. So the first thing for those who are brand new to the 1031 exchange, it falls under Section 1031 of the Internal Revenue Code and Section 1.1031 of the Treasury Regulations. So that's why it's been named the 1031 exchange. You're going to probably hear it referred to as many other names: a Starker exchange, a 1031 exchange, a tax-deferred exchange, a delayed exchange. Those all effectively mean exactly the same thing. You're doing a regular or forward 1031 exchange. So it's really a tax deferral strategy. And keep in mind, it's tax deferred, it's not tax free. There are ways that it can become tax free, but for the most part, you are deferring your taxable gain into the future. So it allows you to sell rental property, investment property, or property used in a business, defer the payment of taxes into the future by reinvesting in other like-kind property. And we're going to get into a lot more details with what that means. So, a lot of folks ask us, when should I use a 1031 exchange? When should I not? Why should I use it? What are the benefits, etc.? So again, it's, the sale of real estate would trigger a taxable gain. And I just noticed we have personal property listed there, and that does not qualify anymore like I indicated at the beginning. So sale of real estate will trigger a taxable gain if you have a profit. And sometimes it might be okay just to trigger that gain and pay the gain. It doesn't mean you always have to defer it. That's one of the reasons you should sit down with your tax and financial advisors to make a decision like that. But in most cases, you don't want to pay the gain, so the 1031 exchange allows you to defer that gain with proper tax planning. But the most important part of this whole process is it allows you to defer the gain, which means you don't pay any federal taxes and you don't pay any state taxes. It keeps all of that money in your pocket working for you. If you combine federal and state taxes, depending on what state you're in some cases it can be about a third of your taxable profit gets paid to federal and state agencies. That's a big chunk of your profit. So with the 1031 exchange, it allows you to keep all of that money in your pocket. You can reinvest it in real estate. It makes it easier to trade up in value, buy a larger property, buy more apartments, more doors, more single-family properties, etc. The end result is increasing your net worth, increasing your cash flow, etc. So it depends on what your goals and objectives are, but it's really a wealth planning strategy. And that brings me to this slide, which is exactly that. Most clients are probably going to exchange throughout their lifetime. Every time they sell a rental, investment, or business use property, they'll do a 1031 exchange. They'll defer the taxes into more replacement property. You keep trading up in value. You buy more properties. You buy more doors. You increase your cash flow. It's all about building the wealth for you and your family. So it's really a wealth building tool. It keeps the wealth in your family instead of paying it to the federal and state governments. So it's all about building your net worth. But how do you really take advantage of this? When does it really stop? And that's what we talk about, going all the way through, exchanging all the way through your lifetime. And when you pass on, you're going to leave the property to family members probably, or somebody else. Whoever inherits the property from you is going to get a step up in cost basis. That means that the property, let me back up. Let me just give you an example. Let's say years ago you bought property for $100,000. Over your lifetime, through all those exchanges, the value of this property keeps increasing, and today it's worth $1 million, and you pass on. You've got a $900,000 taxable gain at that point. And if you factor in depreciation within that whole equation, you've got more than a $900,000 taxable gain, because part of that $100,000 was written off over a period of time. With the death and leaving the property to your heirs inherit the property, and their cost basis is stepped up or increased from your $100,000 cost basis to the fair market value at the date of death. So their cost basis is stepped up to $1 million. They could sell the property immediately for a fair market value of $1 million. Their cost basis is $1 million. They pay 0 capital gain taxes and 0 depreciation recapture taxes. So we have a morbid sense of humor. It's what we call swap until you drop it. Just keep exchanging until you pass on. Your heirs will inherit the property and they pay nothing. Now, why is that? The reason you get this step up in cost basis is because the value of that property, so in the example I use, that $1 million asset value is included inside of your estate when you pass on. So it's part of your estate tax computation. People call it an inheritance tax or death tax, etc., but it's really an estate tax. You've passed, they do a tax return to 706, which adds up all of your value, all of your wealth at the date of death, and if it exceeds a certain amount, you have an estate tax to pay. Because it's part of that estate tax formula, they cannot double tax you. So that's why your heir will receive the property and get a step up in cost basis. Now, most of us will not have an estate valued above the limit. So we will probably never pay an estate tax and we'll never pay a capital gain tax or depreciation recapture tax if we go through the swap till you drop. So that's a quick recap on the real benefit of the 1031 exchange if you carry it all the way through your lifetime. One quick comment there is the step up in cost basis is not always automatic. So it's important to meet with your tax advisor to make sure that you are holding title to all of your assets, all of your stocks and bonds and mutual funds that are maybe held in a brokerage account, your retirement accounts, your real estate, etc., in the proper manner so that you will get a step up in cost basis. It's critical. In some cases, if you're holding title in a different way, you may not get the step up in cost basis. If you hold title to real estate in a C Corp, you're getting a step up in cost basis in the shares of stock in the corporation, not in the real estate. So there's all sorts of exceptions to that rule. So meet with your tax advisor just to make sure we know what's going on. And there's one question posted that says, is there a condition that you may be able to get rid of the depreciation recapture tax? Yes. And so that's what we just talked about. That step up in cost basis is really the only way to get rid of that depreciation recapture tax. If you in the example I gave, if you bought property for $100,000, now it's worth $1 million, and some of that $100,000 is written off or depreciated every year on your tax return. So let's say that $100,000 has been depreciated by $50,000 over maybe a 15-year period or so. If you were to just sell that property outright before you die, you would pay tax, capital gain tax, on the $900,000 in growth or increased value or capital appreciation, and you would pay depreciation recapture taxes on that $50,000 that you have depreciated or written off over the years. So that $50,000 is really depreciation you've written off. If you sell and cash out, the IRS requires you, and most states require you, to recapture that, which means you add it back to your taxable income and you pay tax on it. If you do a 1031 exchange, the capital gain tax and the depreciation recapture tax are all deferred over your lifetime. And if you swap until you drop and pass on and leave it to the heirs, then the capital gain tax and depreciation recapture tax completely disappears. And there was another kind of a follow-up question to that, which is, what about property held in a trust? Good question. In most cases, you probably want to hold title to your real estate in a fully revocable grantor trust, or what people refer to as a living trust, which means that when you pass on, all of the property, all the assets, all the investments inside that trust bypass probate and go straight to whoever you've left it to. And in most cases, when you do it through a living trust, anything in that trust will get a step up in cost basis. Now, again, if you hold title like in a C corporation, that's different. So have your tax advisors take a look at any other entities that might be involved. but generally anything in a living trust would get that step up in cost basis if the living trust owns the asset directly. And that's really, I shouldn't say always, but it's very common to be the best way to hold title to real estate, because you want the property to bypass probate. You don't want to have to go through probate. You don't want to have to pay probate fees. Here in California, where I'm located, probate is 3%. So it's just a 3% across the board. Well, if you have a big estate, that's a big number. If it's in a living trust, it bypasses probate. You do not pay that 3%. It goes straight to your heirs. They get immediate access to the assets. If it goes through probate, that could take 6, 12, or more months. So always better to do that. So the trust in most cases is good. That is also the case for a title holding trust, or what a lot of people call a land trust. That's also a fully revocable grantor trust. So the land trust will also bypass probate, etc. Okay, let's jump into the actual 1031 exchange structures. And this is where we're getting into the meat of the concept of the topic. And we're also getting close to where there's a lot of the misinformation, confusion, etc. that pops up. So first, we talked briefly about the different types of exchanges when I was making the introduction. There's really 3 types. There's a forward 1031 exchange, there's a reverse 1031 exchange, and there's an improvement 1031 exchange. People also call those build-to-suit exchanges or construction exchanges. So by far, and in our case, 97% of our transaction volume are forward 1031 exchanges. That means you're selling your relinquished property first, the property you currently own. You're going through the 1031 exchange process, and you're reinvesting in replacement property after the sale, but within the timelines required for 1031 exchange purposes. And we'll cover the timelines in a little bit. Forward exchanges could be concurrent or simultaneous, so the sale and the purchase all close on the same day. That's probably the best, the safest way to go, because it's done and you know you've got all of your apples and oranges in the basket. They're closed, it's done, you don't have to worry about it. The risk with a forward 1031 exchange in most cases is you're selling first and then you buy your replacement property later. That means you've sold your relinquished property, you've triggered your gain. The question is, can you find suitable replacement property? Can you identify that property? And can you acquire that property through the 1031 exchange? If you can, it's all tax deferred. But if something happens, something goes wrong, and you can't find property, or you can't acquire it, or you get into a bidding war, etc., and you can't acquire that property, then the forward exchange fails and it becomes a taxable sale, and that's the risk with a forward 1031 exchange. But it's the simplest, it's the most straightforward, it's the easiest to do. So again, 97% of the clients do forward 1031 exchanges. You sell first and buy second. And we've got a couple other questions that were posted, so let me try to go through a couple of those. One is, what about holding title in an LLC, which only husband and wife are the members of the LLC? Good question. We're going to talk about that later, but I'll touch upon it real quick right now. So with an LLC, the answer is it depends. That's you guys will get tired of this because that's my favorite answer. It depends. But if the LLC is a multiple member LLC, so 3, 4, 5, 6 investors going together to buy property, that's treated as a partnership for tax purposes. It's considered a separate legal entity, both for legal purposes and for tax purposes. And we'll get into why that's an issue later. If it's an LLC where husband and wife are the sole members of the LLC, then it depends on what state you're located in. If you're in a state that is a community property state, the husband and wife are treated as one sole taxpayer or one sole member of the LLC. So even though there's 2 members, it's still treated as a single member LLC. And if you set it up and you're treating it properly, it should be considered a disregarded entity, and that's critical. If it's a disregarded entity, then it's treated as if it's the same as the husband and wife. So for example, if husband and wife own real estate, rental property in an LLC, and they sell that property and they do a 1031 exchange and they go to buy, let's say, a small apartment complex, and they want to buy it in the LLC because that's how they own their real estate and that's how they sold their relinquished property, They go to close, and the lender says, we're not going to finance your multifamily property in an LLC. You have to buy it in your individual names. In this case, it will be okay because you've sold as you've sold as an LLC. You acquire as husband and wife, but that husband and wife is the sole member of that disregarded entity, and it's all treated as if it's the husband and wife. So for tax purposes, the husband and wife sold relinquished property, and the husband and wife bought replacement property regardless of that LLC. Now, if the husband and wife elect to treat that LLC as a partnership for tax purposes, then it's a whole different ballgame. Now it's a separate legal and separate tax-paying entity. So the example I just used would not be the case. So it depends on how you've been treating this. If it's just a single member LLC, if I set up an LLC and I am the sole member, then in all 50 states, that's a single member LLC. And unless you've elected some other treatment, it will be a disregarded entity. And then it doesn't matter whether you are personally using, buying or selling in your individual name or the LLC, because it's a disregarded entity. So the issue there is the entity disregarded for tax purposes? It could be as simple as filing the wrong tax return that could make an election to be treated as a partnership. So consult with your advisors to make sure it's a disregarded entity. And we'll go a little deeper on that later. There's another follow-up question about what about an irrevocable trust? Good question. I should have mentioned that with the last question. An irrevocable trust usually means, there's a lot of different types of irrevocable trust, but it usually means it was a grantor trust, it was fully revocable, it was a husband and wife that set it up, they're the trustors, husband or wife has passed on. And once there's a death of one or both of the trustors, the trust usually becomes irrevocable. That means you cannot revoke it, and it becomes permanent. Once it's an irrevocable trust, now it has its own taxpayer identification number. It files its own tax return, so it files a 1041 fiduciary tax return. And it's considered a separate legal entity. So generally, the irrevocable trust will sell real estate, do a 1031 exchange, and then buy replacement property at the irrevocable trust level. There are ways to do it a little differently. It depends on the circumstances. So I don't want to get too broad here or it might get misleading. So the safest way is if property is held in an irrevocable trust, do the entire 1031 exchange at the irrevocable trust level. Let's see, next question is, when you combine 1031 exchanges with a 121 exclusion, do you still pay the depreciation recapture tax? Good question, yes. So if you, actually I'm going to get into examples of how you combine the 1031 exchange and the 121 exchange at the back end. The 121, the 121 exclusion will not exclude depreciation recapture. The 121 exclusion will only exclude capital gain or appreciated value. And we'll get into a little more detail on that later on. And the the one last question, then we'll go on with the program. If I can't find property I like, is there another option for me to invest my money into to satisfy the 1031 exchange requirements? Yes, so you can certainly have multiple options to reinvest. Most people go out and will work with their real estate agent and find property, identify it, and acquire it. But some folks are, either one, they want to get rid of property management headaches. They're tired of the terrible T's, as people call it, the, toddlers, taxes, termites, teenagers, toilets, et cetera, et cetera. And they want to get rid of all that and exchange into something that is easier to manage. So you can look at other types of assets like net lease properties. Net lease properties could be a Walgreens, a CVS Pharmacy, a Jack in the Box, a Starbucks used to do them, where you buy 100% of the asset. It's leased to one tenant. It's a credit quality tenant. They're responsible for everything, all the property management, and you just get a one net check from them. So it's called a net lease. That's one option. You can look at something called a Delaware Statutory Trust, or DST. And the Delaware Statutory Trust really allows you to identify a very specific percentage interest in a trust. The trust will own either one or multiple properties, and that is considered replacement property for tax purposes and qualifies for 1031 exchange treatment. So the Delaware Statutory Trust has many benefits there. One is some people just want to get rid of property management, so they identify and buy DSTs to get out of the property management game. Some will use the DST as a backup. They want to go out and find their own property, but what if I can't find property? So they could identify a Delaware Statutory Trust as one of their identification properties. Others may acquire property they want, but they have a little bit of cash left over and they really would prefer not to pay tax on it. So they could use whatever's left. Maybe it's $50, $75, $100,000. You could identify a really small percentage in a DST and use that to acquire part of a DST. So that would be certainly a great strategy for those who are trying to get out of property management headaches, or use it as a backup, or use up a little bit of extra cash. The other thing I like about the Delaware Statutory Trust is that you as the investor do not have to qualify for the debt. The sponsor puts the package together, puts debt on the property, and brings it to market, and you just assume a percentage of the debt, but you do not have to qualify for the debt. It does not show up in your credit report, et cetera. So for those who have self-employed income, retired with no earned income, et cetera, and can't qualify for financing, the Delaware Statutory Trust can be a great solution there as well. Okay, with that, sorry I jumped ahead there. Let's go back to the 1031 exchange structure. So we talked about the forward exchanges. And again, the Delaware Statutory Trust, jumping back a little bit, can be a great solution to help minimize the risk on a regular forward exchange. In today's market, we have a lot of complexities out there. We have a short supply of real estate. It's a very tight inventory. We have some of the markets are still very hot. It's still very much a seller's market. You might get into bidding wars, multiple offers, and the risk, like I said, with the forward exchange is you sell, and if you cannot acquire your replacement property for whatever reason, it fails, you pay tax. So one of the ways to address that, and I'm going to kind of expand on this rather than just talking about reverse exchanges, because we had a couple questions before the webinar on this. And this is, what strategies can I use to deal with this issue? So before we go into reverses, the whole issue here boils down to timing. When you sell your relinquished property and it closes, and that's the trigger point, the close of the sale of your relinquished property, that starts your 45 days to identify what you're going to buy, and it starts your 180-day exchange period. So if there's a way to delay the closing, then you delay the start of your deadline. So on the sales side, if you can talk to the buyer and say, look, I'm trying to do a 1031 exchange, I need more time, will you give me a long closing process? If it's an escrow or closing through a title company, can you give me a 90-day closing period? Or if you give me a 30 or 45-day, can you give me a whole bunch of 30-day options to extend? Perhaps you lease the property to the buyer so they can start to use the property, but you actually don't sell it to them until later. Any way you can satisfy the buyer, delay the closing, buys you more time to find replacement property. On the buy side for your replacement property, you want to go out and start looking for replacement property as soon as you can. A lot of investors wait till they're in the 45-day period, and I'll tell you, that adds a lot of stress to your life. So go start looking for replacement property first, and if you find property you like and you haven't sold your relinquished property yet, the same thing goes. Find a way to tie up that replacement property. Can you lease the property from the seller with an option to buy, or just enter into an option to buy? Can you buy the property, go under contract, but have a long-term closing? Will the seller give you a number of options to extend the time frame? So either on your sale or your buy side, if you can find ways to delay the closing or accelerate the closing, et cetera, that's what it's all about. And one of the questions we had before the webinar was how to, what should you know to worry about, what you should look out for, what kind of mistakes are made. I think one of the biggest mistakes are people who wait. They delay looking for replacement property. They don't have a plan of attack. They haven't really thought it through. So the way to address that issue is to plan ahead, know clearly what you're going to do, what you're looking to buy, who you're going to work with. Have your team together. Don't wait till you're in the 45 days to find a real estate professional. Have everything lined up. You got to stay on top of your transaction and stay on top of your deadlines. It's critical to do that. And that will take a huge amount of the risk and the stress off of you by doing that. Now, having said all of that, sometimes you're in a position where you have to close on the replacement property first. Long-term closing, options to extend, lease with options to buy might not be an option. The seller may just say, look, it's a seller's market. I'm going to go out there and find another buyer. And you really want the property. So a reverse 1031 exchange would allow you to acquire, so make an offer, go under contract, go into closing, and actually close on the purchase first. And then you've got 45 days to identify what you're going to sell, which is probably just a formality, and 180 days in which to market and sell and close on your current relinquished property. So the reverse exchange could take a lot of the risk out of today's market because you buy first, you actually close, you've got the property locked up. There's no risk about what if I can't find my replacement property. The downside is they're more expensive and they're more complicated. It's not as simple as acquiring the property and taking title to it and then selling your existing property. That would be a pure reverse exchange. With a pure reverse exchange, you would buy your new property, take title, own both at the same time, and then sell your existing property. That does not exist. It's not permitted by the IRS. So to do the reverse exchange, when you close on the purchase, the qualified intermediary is going to set up an exchange accommodation title holder to acquire and hold or park title to that property. If there's a lender involved, the lenders are not terribly excited about us holding title to your property when you're the borrower. So if it's a traditional lender, a conduit lender, where they typically make a loan, package the loan into an investment pool and sell it off to Wall Street, they're not going to consider a reverse exchange because they're not going to allow us to hold title to the property. Hard money lenders, private money lenders, life insurance companies, local community or regional banks will often take a look at that. They may allow this structure. So the key there when looking at a reverse 1031 exchange is first talk to the lender. We'd be happy to jump on a conference call with you and the lender. We'll walk them through the mechanical steps. If they're going to say no, we want them to say no up front so you don't get a surprise just before closing hits. But the reverse exchange will take a lot of that risk out of that entire process. They're also more expensive. With reverse exchanges, we take title to the property. We get sued every year 3 or 4 times just because we're in the chain of title. So the risk to the 1031 exchange company is legal fees and dealing with all sorts of weird stuff that comes up. So most reverse exchanges administered by quality companies that really know what they're doing are going to be, the fees will be somewhere in the area of say $6,000 to $9,000, which should include everything. It should include all of the regular 1031 exchange documents. It should include all of the parking arrangement documents. It should include all of the costs related to a brand new LLC just for your parking arrangement, etc. And we have one quick question that popped up. It's on a forward exchange, can you sign the contract on the new property before you close on the old property? Good question. Yes, absolutely. The thing that triggers deadlines is the closing. So you can, on the sale side, on the buy side, either one, you can go under contract, you can open escrow or go into closing. As long as you don't actually close, you're okay. So on the buy side, if you enter into a contract, if you open escrow, if you go into the closing process, but don't actually close, you're perfectly okay. And then as long as the relinquished property sells first or closes first, or closes concurrently with the purchase, then you're in great shape. The only time you'd have to do a reverse 1031 exchange is if you actually close on the replacement property before you close on the sale of your relinquished property. A third structure is an improvement exchange, and you don't see a whole lot of these because of the time frames involved. With an improvement exchange, you're selling a relinquished property, you're using some of the cash proceeds to acquire replacement property, and you have cash left over to make improvements, capital improvements, repairs, maintenance, things like that to the new property. It does have to be some type of a capital improvement to qualify. The problem is you have 180 days, and whatever is spent or paid for and completed, so it has to be completed during the 180 days to count. So let me give you a quick example of how this would work. Let's say you sold $1 million property, you structured a 1031 exchange and decided to buy dirt and build on it. So you decide to convert your 1031 exchange into an improvement 1031 exchange. So at this point, you've sold for $1 million and you enter into a contract to buy dirt, and the dirt, let's say, is $250,000. So we purchase the dirt, we close on the dirt, and we disperse $250,000 of your exchange proceeds to pay for the dirt. You now have this dirt. Through an improvement exchange, rather than you taking title, we would take title, just like a reverse exchange. We set up an LLC, we park title to that dirt. That's what allows you to acquire the property but not take title to it, and gives you the rest of your 180-day exchange period to spend the remaining $750,000 to build out the property. So we sold for $1 million. We have spent $250,000. We have $750,000 left. Let's assume this build out is going to be a $5 million project. We don't care about the $5 million. All we care about is making sure that by the end of the 180-day exchange period, you have at least $1 million in equity invested in this new property, and you've got at least $1 million of real estate completed. So we've got $250, we bought that, that's real property. We have to spend $750,000 in cash to use up the balance of the proceeds. And the construction related, the improvements related to that $750,000 have to be completed. The $5 million does not have to be completed. All we care about is we get at least $750,000 of construction costs and the corresponding construction paid for and completed by the end of the 180th day. At that point, we wrap up the 1031 exchange process, and you can take the property from there. We transfer it to you, and you can do the rest of the other $4 million build out after the fact. We just need to make sure that you have reinvested the $1 million to count. And that was a quick whirlwind tour on improvement exchanges. We'll get into a little more of that stuff later. For the 1031 exchange, let's get into the nitty-gritty, the mechanical steps. So number one, you have to have a qualified intermediary. The qualified intermediary should draft all the exchange documents and must be in place before anything closes. The documents include an assignment document. The assignment document assigns the purchase and sale agreement or the sales contract, whatever you call it, to the qualified intermediary. That means the qualified intermediary steps into your shoes. We become the seller, and then on the buy side, we become the buyer. And that's what wraps it all into the 1031 exchange. If the 1031 exchange is not set up and in place before closing, when the sale closes, you as the investor have the right to receive the proceeds. So even if you tell the closing agent, don't disperse the money, I'm going to do a 1031 exchange, it's too late because you have the right to the funds. So make sure the qualified intermediary is in place and the 1031 exchange is set up before anything closes. So the role of the qualified intermediary is really a couple of things. One is drafting all the legal agreements and the related transaction documents and reviewing the purchase and sale agreement, et cetera, to make sure the 1031 exchange is adequately set up and in compliance with everything. Number two, we're going to receive and hold and safeguard your equity, your 1031 exchange funds, in a separate, segregated, dual signature qualified trust account. We're going to talk more about that later, but that is critical. The qualified trust account is critical. A lot of exchange companies do not use separate segregated accounts. They do not use separate segregated qualified trust accounts. And those that do, they don't always have dual signatures, and you want to be able to have the ability to approve your own disbursements. And number three is we serve in an advisory and consultative capacity. We work with the clients and the client's advisors to walk you through the process and help you kind of navigate the waters there, so to speak. kind of going hand in hand with that is, how do you protect your 1031 exchange funds? And a lot of investors don't realize that 1031 exchange companies, qualified intermediaries, are not licensed, they're not regulated, they're not audited, they're not required to be bonded in most states. So it's kind of the wild, wild west. In fact, less than 1% of qualified intermediaries have any kind of government oversight at all. Even the big ones are subsidiaries of large companies, but they don't have any direct government oversight. So what's critical is to make sure that you have a qualified intermediary that is licensed, regulated, and audited, which means they have a government body looking over their shoulders, checking their work to make sure they're operating in a safe and sound manner. Part of this involves using a separate, segregated, dual signature qualified trust account. So going back to what I said at the very beginning, this is one of the reasons we decided to go through the entire regulatory approval process to become a trust company. We applied with the Division of Banking and got the trust charter. So Exeter Trust Company now is licensed, regulated, and audited by the Wyoming Division of Banking. We're audited once a year by the bank examiners. And through that entity, we offer separate, segregated, dual signature qualified trust accounts. Now that's critical because it holds your funds in a trust account. They are clearly client or fiduciary funds. So if anything ever happens to the Exeter entities, the funds are held in a fiduciary account. The state of Wyoming would come in and take them over and continue operating and administering the 1031 exchange transaction. So it gives you a huge amount of protection compared to most qualified intermediaries. The fact that you have a dual signature also means that both Exeter 1031 exchange as the qualified intermediary and you as the investor have to authorize Exeter Trust Company to disperse funds to make sure that it's safe, etc. We have another question, actually, a couple of questions, it looks like. No, I guess just one. So, not quite sure what that last question is. So I'm gonna hold off on that one. So going back to what else you should look for to protecting your funds, you know, a lot of people focus on the bonding, and bonding is critical, and I'll go over that in a minute. But what we have seen, because we do a lot of expert witness work, is the biggest area where losses occur is a qualified intermediary that did not review the documents and missed something. They didn't catch a problem, and then the closing occurred, and once the closing occurred, it's almost impossible to fix things. So you really want to look for a qualified intermediary that has extensive experience and expertise in 1031 exchanges, and that are willing to review all the documents and point out any potential problems before closing occurs. Almost anything can be fixed before closing. That's going to be the biggest way that you can mitigate your risk. Number two, everybody's human. There's always things that are going to happen, so you want to make sure they have errors and omissions insurance. That protects and insures you. That if the qualified intermediary creates a loss, you're covered because of an error or omission in the documentation or the transaction, etc. You want to make sure there's fidelity bond protection. Fidelity bond is crime insurance. That covers you in case the qualified intermediary steals your 1031 exchange funds. Ask for a copy of the insurance binders and ask for the insurance agent's contact information so you can verify coverage. Those are all critical. And it's difficult to say what is the most important. I would make sure that they have all of these, otherwise I wouldn't use the company. That's critical. Okay, let's get into qualified use requirement. Now this is probably the most important slide of the entire slide deck. This is also where there is the most misinformation out there. This is where we get most of the questions where people say, I talked to 3 or 4 people and I got 3 or 4 different answers. And it's called qualified use. The relinquished property you sell and the replacement property that you acquire must all be held for some type of qualified use. And that includes rental. So any type of property that you rent or lease out and it produces some kind of income production, that's going to qualify for 1031 exchange treatment. Property held for investment, so it doesn't have to produce cash flow. You could buy dirt and hold the dirt for capital appreciation. That's considered investment property and will qualify for 1031 exchange treatment. You could also buy property to use in your trade or your business. Maybe you have a little retail store, a little office. You could buy office building and operate your business out of it. You could buy a retail store, operate your business out of it. Anything used for a business purpose will also satisfy the qualified use requirement. So what doesn't? Anything that you are buying with the intent to sell is not technically considered held for investment purposes. So let me back up. The critical factor here is your intent. It is absolutely critical that you have the intent to acquire and hold your relinquished property and your replacement property for some type of rental, investment, or business use. The area where we get the most confusion in is a holding period. People will call and say, talk to 3 or 4 companies, and one person said, you don't qualify unless you hold property for at least 1 year. Somebody said 18 months. Somebody else said a year and a day. Somebody else said 24 months. So what is technically correct? The answer is those are all opinions. The tax code and the regulations and the rulings out there do not have a specific holding period required. There is no holding period. What is critical is that you have the intent to hold for rental, investment, or business use. So the longer you actually hold the property, the safer it is. Because if you get audited, the issue is you have to be able to demonstrate you had the intent to hold for rental and investment purposes. The shorter the holding period is, the more difficult it is to prove the intent. It looks more like you bought the property with the intent to flip it. But it doesn't matter what the timeline is. So let me give you a few examples. There's a couple tax court cases where both were developers, both bought dirt, both intended to build single family and sell, just like developers do. Neither one built or developed anything. One held the dirt for 12 years and one held the dirt for 20 years. In both cases, they ultimately ended up selling the dirt and doing 1031 exchanges. In both cases, they got audited. And the industry thought, my God, this is a long-term hold, 12 years and 20 years, this will count or qualify. But in their case, their intent was to buy, build, and sell. It was held for sale like inventory in a development business. So under audit, their 1031 exchange transactions were disqualified because their intent was not to buy, build, and hold. It was to buy, build, and sell. It was held as inventory. Now, somewhere along the way there, their intent could have changed. And had they notified their banker, their accountant, their attorney, their real estate agent, et cetera, that now they're going to hold the property for investment purposes, that their business model has changed, the market has changed, what have you, and if they had structured this and reported this and treated this as investment property, it could have qualified as a 1031 exchange. So we get a lot of questions that, well, how would I do that? Emails back and forth between your advisors talking about, I bought this to develop, but something has changed. Now I'm just going to hold it for investment purposes. Emails to your accountant. What does this do to me from a tax perspective? Can I depreciate the property? How do I depreciate it? What's the write-off? Changing your tax return to show it as property held for investment as opposed to property held for sale or development or rehabbing or flipping, financial statements, mortgage loan applications, everything would show it as property held for rental, investment, or business use instead of property held for development, flipping, etc. If you can show your intent was to hold for investment purposes, it would qualify. On the flip side, we had one of our clients who did an exchange, bought a condo, did not read the CC&Rs until after they closed on the purchase. About 2 weeks into their ownership of the property, they read the CC&Rs and found out they were not permitted to rent the property. It had to be owner occupied. So they, of course, called in a panic because their intent was to rent it out, and now they have the property they can't rent out. So with all the panic emails going back and forth, et cetera, they did an exchange. They held title for about a month and a half. Of course, as luck would have it, they were audited by the California Franchise Tax Board. And the California Franchise Tax Board actually allowed their 1031 exchange transaction because of all the emails, especially the panicked emails. It was very clear their intent was to buy and hold for rental purposes, and so that would qualify. So the length of time you hold title to the property is not the critical issue, it's the intent. The longer you can hold title, the easier it is to prove intent, but it's all about proving intent. So anybody who's in the business of buying property and building or developing, so developers, contractors, builders, you buy, you build, you generally have the intent to hold for sale. That's not going to qualify. Anybody who's in the business of buying real estate to rehab, they usually buy, they rehab, and they sell or flip. Or if they're buying and just assigning the contract and wholesaling, none of those have the intent to buy and hold for investment purposes. They're buying and holding for sale, so they don't qualify. So that gives you kind of a quick overview on qualified use, and that's the most critical part of that whole issue. Let's see, we have a quick question on, can you repeat the cost to do the 1031 you are referencing now? Yes, so let me quickly go over, I'll go over all the costs for 1031 exchange purposes, and I'll kind of give you an idea on the regional areas. So on the West Coast, if you're doing a regular forward exchange, most regular 1031 exchange fees are somewhere between $750 and $1,200. The more you go east, you're going to see those fees go up because there's less competition, and sometimes there's attorneys doing them, so you'll see fees go up to maybe up to $2,500 on the East Coast for a regular forward 1031 exchange. Most of us who are national qualified intermediaries are probably right in the $750 to $900 range. That's what you can expect for the sale of one property and the purchase of one property. And then generally there's an additional property fee, so if you sell one and buy two, the second purchase will be an additional fee of say $200, $300, $400 to acquire that property. When you get into reverse exchanges or improvement exchanges, those are going to be a much more expensive proposition. And those fees are all over the board. Most of the national qualified intermediaries who really know what they're doing on a reverse exchange are going to charge somewhere in the $6,000 to maybe upward of $9,000. Our fee is $6,850 as a base fee. And for 98% of our reverse exchanges, our fee would be $6,850. Improvement exchanges, there's more risk to us. There's construction activity going on, so that's going to be a little bit higher. Our base fee for for improvement exchanges are going to be about $7,850. That covers most of the improvement exchanges. There's some moving parts there, so we have to look at all the moving parts and see if there's any additional risk to us or additional work. But that gives you kind of a flavor for what the fees are. With reverse exchanges and improvement exchanges, you occasionally see exchange companies that charge, $2,500, $3,500, $4,500. Be very careful. They're taking shortcuts on the exchange. With a reverse or an improvement exchange, we are acquiring title, we're parking title, and technically we have to report that on our corporate tax return as property acquired and held for sale. And I know there's exchange companies out there, especially those that charge the lower fees, that they bypass that. And technically under audit, that would disqualify your reverse 1031 exchange. So be very careful with the lower fees. You're just asking for trouble there, so be very careful. Let me see, a couple more questions here. We'll cover advice on a forward 1031 exchange into a new rental that I want to move into later. Good question. So basically the question is, you're selling relinquished property that's held for rental, you're doing a 1031 exchange, you're buying replacement property, and ultimately you want to move into that property as your primary residence. Again, it all boils down to intent. That's the critical factor. So we want to be able to prove your intent was to hold for rental, investment, or business use, and later your intent changed. So we're more conservative. So our recommendation is do the exchange, make sure everything looks like it's investment property, that it is investment property, and it's treated and reported as investment property. Make sure any financing you get is an investment property loan, not an owner-occupied loan. That way there's no red flags that might raise a concern. I personally would rent the property out for 24 months, 2 years. That's going to straddle 3 separate tax returns. Really strong proof that was the intent to hold for rental or investment purposes. And then after that point, your investment intent can change, and you could decide to move into the property as your primary residence. Now, we usually follow-up questions are, well, can't I do it sooner? It's possible. For example, if you had something that was way outside of your control, a recession hits and you lose property and you have to downside, You can document that you had to move into the rental property sooner, and there's a business reason, a financing reason for doing that. Medical conditions, you may have to sell off properties to pay bills. You may have to move into the property to be closer to a family member who needs help. So if there's a reason and you can document the reason that your intent was to hold for rental and investment purposes, but something happened, and this is why you did it, you should still be fine. You'll qualify. But without a good reason, I would rent it for 24 months just to be safe. A lot of advisors will recommend 1 year, 18 months. I think that's for a plain, vanilla, regular 1031 exchange with nothing out of the ordinary. If you want to move into it, or you're going to move out of it and sell it later, do an exchange on the relinquished property side, either way, I would make sure you've got 24 months of rental, or at least straddle 3 tax returns just to be safe. Next question. Oh, someone asked about what about cost for foreign 1031 exchanges? That's a good question. With foreign properties, there's only a couple of exchange companies that will handle any type of foreign property transactions. Some of them will price it as a regular 1031 exchange, and so it sounds great. Keep in mind, those companies, what they're doing is they may charge you $750, $850, $950, something like that. But then when the sale closes, they're going to require that the funds be wired to them here in the U.S. They're going to convert those to U.S. dollars, and they invest them, and that's how they make their money, is off the interest. The problem with that in a foreign property transaction is now you as the investor are exposed to foreign currency risk, because once you have to convert back into whatever the currency is to acquire your replacement property, you've got a delay there. And if there's been any shift in the foreign currency exchange rate, you may take a loss or you can make a profit. And so in our case, we don't do it that way. We charge a flat fee, and generally it's a $5,000 flat fee. But we are set up to actually receive and hold in 24 different foreign currencies. So if it's in the UK and it's the British pound sterling or it's the euros, etc., you would have them at the closing. They would wire to us in euros or pound sterling, and we would hold in euros or pound sterling. And then when you're ready to buy your replacement property, we would wire back in euros or pound sterling. That way there is no currency risk to you, and that's a much safer way to do that. So it depends on the exchange company that you're working with, but there's only 2 or 3 that actually will do them, and the others will force you to convert to U.S. dollars. Next question is, are those fees included in the exchange formula as a reduction? Yes, so exchange fees of all types are permissible exchange expenses and can be subtracted as a routine selling expense as part of your 1031 exchange transaction. Next question, what is your fee for a normal forward exchange as well as your additional fee for a second? Our personal fee here is $899 for a regular exchange. That includes the first sale and the first replacement property. Each additional closing, if you will, is $300 to process. Next question is, can I include the cost of rehabbing a rental property that needs improvement? Good question. Yes, that would be the improvement 1031 exchange transaction. And if the improvements aren't a lot, then you could do the improvement exchange within that 180-day window. But that you'd have to go through the actual improvement process or improvement 1031 exchange. So you'd have to make sure the amount of funds you're talking about is sufficient to warrant the improvement exchange fee. Okay, I think we covered the holding period requirement, etc. Let's talk about like-kind property. There's lots of misinformation here as well. It amazes me how many people out there, when they're giving seminars and webinars and what have you, still say if you sell a condo, you have to buy a condo. Absolutely not true. Like-kind simply means you're selling real estate, you have to buy real estate. Simple as that. So any kind of real estate qualifies. So the only limitation is it has to be all domestic real estate or all foreign real estate. You can't go from U.S. to foreign or foreign to U.S. Other than that, like-kind means sell real estate, buy real estate. So let's get into a quick definition of what is like-kind property. And here's a listing of all the different types of property that's considered like-kind. And you'll notice it includes oil rights, water rights, mineral rights, air rights, oil and gas interests, etc. All of those are usually considered to be real estate under state law, so that would qualify for 1031 exchange treatment. Fractional ownership, which might be a percentage acquired through a tenant in common arrangement, or it might be through a Delaware statutory trust that we talked about, qualify as an interest in real estate and like kind for 1031 exchange treatment. Vacant land, undeveloped land, farmland, ranch land, all of that also qualifies as long as it's held for some type of rental investment or production in like a producing ranch or a producing farm. The portion that's used as your excuse me, primary residence would not qualify as investment property, but the rest of the ranch or the farmland would. Okay, we've got a 453 exchange question, so I'm going to put that off for a minute. If I could, I'll cover that in a little bit. Are the fees to an architect included in improvement costs? Yes, absolutely. Sorry, I got a cough here. With an improvement exchange, any soft dollar costs, architect, legal fees, permitting, etc., would all be considered part of the cost. And those would all certainly qualify. Next question. When I list my rental property for sale, do I need to let my realtor know that this is going to be a 1031 exchange? I am looking at a DST. Yes, you should. They generally have different types of disclosure documents. Different states, like here in California, would have the California Association of Realtor Documents, and there's usually a disclosure page that talks about a 1031 exchange. You don't have to disclose the exchange for 1031 exchange purposes, contrary to popular belief. As long as the exchange is set up properly, you don't have to, the contract doesn't have to have any language on a 1031 exchange. But for other purposes, you might have to disclose that it's a 1031 exchange. So I would tell the realtor, you may not want to tell the realtor on the other side yet. Sometimes during negotiations, it could be used against you. That's probably more of an issue on the replacement property side. If they find out that you've identified their property and you're past the 45-day window, they can use that against you. If you're going, I would also, same question, I would notify your closing agent because they're going to draft things a little differently. If you let them know at the day of closing, they're going to be a little stressed out. Is the PowerPoint available for download? Yes. In fact, on your sidebar, the panel, I think there's a section that has downloads and you can download it from there. If not, after the webinar is completed, there should be a link to the PowerPoint. And if for some reason that doesn't work or doesn't happen, just let us know. We can certainly email you out a copy. Next question, personal use of a portion of the rental unit, etc. So one unit is it's like a duplex and one side is rental, one side is personal use. Good question. So that would certainly qualify as to half. If it's a duplex and both units are exactly the same size, let's say you sell $1 million property, you buy a duplex for $1 million and you're going to live in half. That means half of the property value would not count. You've technically sold for $1 million and you've bought or reinvested only in $500,000 for rental property purposes. Excuse me. But if you sell for $1 million and you buy a duplex, and let's say you buy the duplex for a lot more than $1 million, as long as half that value is at least equal to or greater than $1 million, that 1031 exchange would be okay. So the portion that you live in just would not qualify. Okay, let's move along real quick. There's a couple other questions. I'll take them in just a minute. So we talked about like-kind property. Let's quickly talk about non-like-kind property. So anything used as a primary residence, second home, vacation home, etc., anything with personal use or excessive personal use will generally not qualify for 1031 exchange treatment. Now, this is your intent. So intent can change. So if it's a second home, which means you're using it as a personal residence, or maybe you've got a family member who lives there rent-free, it's a second home. You could always stop treating it as a second home or a vacation home, start charging rent and convert it to rental property. Now it would qualify. So again, it's all about intent. I personally would rent it again for 24 months to prove that was your intent, but rent it as long as you can to prove your intent was to convert it to rental property, and then it would qualify for 1031 exchange treatment. This one shows some other areas where non-like-kind property could be an issue. So the basic message here is, if you own real estate in some type of an entity, and we briefly talked about limited liability companies at the very beginning. So if it's a single member LLC, if it's a disregarded entity, if it's a land trust, if it's a revocable living trust, those are exceptions. But let's say you own the real estate in an LLC and there's multiple members, it's treated as a partnership for tax purposes. Remember that you're not the owner of the real estate. You own a membership or a partnership interest in the LLC, and the LLC actually owns the real estate. So the taxpayer or the entity that's selling the property and doing an exchange is the LLC. Now, if the LLC is sticking together and everybody's going to sell and buy and reinvest and stay together, it's not a big deal. The partnership goes all the way through together. It gets challenging when the partnership wants to break up. So maybe all of the members or some of the members in the LLC don't want to go forward with the 1031 exchange. That's when we have complexities, and we have to look at the transaction. We have to look at each of the goals and objectives for the different members and try to find a solution. There are many solutions there. We just have to go through and see what the possibilities are. So if you own property in some type of an entity, a C corporation, an S corporation, a multiple member LLC, a formal partnership with a partnership agreement, a limited partnership, I would recommend talking to your legal and tax counsel today. Define what your future exit strategy is going to be. What will that look like? And if you think the partnership is going to want to go different directions, now is when you want to address that. Because what happens a lot of times is they come up to closing and they say, oh my gosh, we're all going to go different directions. The partnership deeds the property out to the individual members. The individuals now become tenants in common with each other. They sell, they do exchanges, and they get disqualified because the individuals did not intend to acquire and hold the property for investment. They acquired the property merely to do a 1031 exchange. So we need some seasoning with whatever the solution is. And there are ways to do things at the last minute. It just gets more complicated. We don't have a whole lot of time to go into those right now. Okay, let's move on here real quick. The 1031 exchange deadlines are pretty straightforward. When your sale of your relinquished property closes, you've got exactly 45 calendar days to identify what you're going to buy. That moves very quickly. We talked about ways of delaying the close, etc. Plan on that 45 days. Be on top of it. Get prepared well in advance, and that'll satisfy the issue. And you have 180 days from the close of the relinquished property to actually complete your entire 1031 exchange. And it's exactly 180 calendar days. So you've got 45 days, plus you've got an additional 135 days to complete your actual 1031 exchange transaction. And I'm kind of got the slides mixed up, so I bounce back and forth there. So here's the identification requirements. During the 45-day period, you can identify under 3 different rules. You only have to satisfy one of these rules. One is you identify not more than 3 properties. That's the easiest one. That's what most people use. Usually because they're going to buy one property and trade up in value, you identify 3, you intend to acquire 1, and the second and third are backup properties. And one of those backup properties could be a Delaware statutory trust. If you're selling a larger asset and want to buy a whole bunch of smaller assets, that's when they would look at the 200% rule. And in that case, you can identify up to 200% of whatever you sold. If you sell $1 million property, 200% would be $2 million. You could identify a whole bunch of single families in Tennessee for $40,000 a pop, up to $2 million in value. So it's a limit on the value, not the number of properties. Or you've got the 95% exception, where if you violate the 3 property and the 200% rules, as long as you close on 95% of the value identified, you'll be okay. Reinvestment requirements. How much do you have to reinvest in order to defer all of your taxes? And the general rule is you have to have the intent to reinvest. We've been talking about intent. A lot of things revolve around intent. You have to buy one or more replacement properties that have a total value equal to or greater than what you sold, so trade equal or up. And you have to reinvest all of your equity, your net cash proceeds. Contrary to what you see on the internet, you do not have to replace your debt. Most things, most articles, most webinars, etc., say you have to replace your debt, and that's because most people don't have cash laying around. But if you wanted to, you could buy your replacement properties and pay all cash with no debt. And as long as you are trading equal or up in value and you've reinvested all of your exchange proceeds, you're replacing whatever your old debt was with new cash, that will qualify. And that's really the issue. I mean, you don't have to replace debt unless you don't have cash, then of course you'd have to replace debt. We had a couple questions on the pre-webinar forms too about partial 1031 exchanges, so this is going to address all of those. Partial exchanges are absolutely okay. You can trade down in value on purpose, or you can pull cash out on purpose. Let's say you sell for $1 million and you decide to reinvest at $800,000. You've traded down by $200,000. Ignoring closing costs, that $200,000 would be taxable boot. You would pay tax on the $200,000. You do not prorate your cost basis. So when you're trading down, the entire $200,000 is taxable. You do not get to write off any of your cost basis against that, but it's okay. It does not hurt the 1031 exchange. It just means you're going to pay some tax. The same with pulling cash out. You pull cash out, you didn't reinvest that cash, it is taxable. It doesn't hurt the 1031 exchange, but you will pay tax on the cash you pull out. One way to do that is reinvest all of your cash, trade equal or up in value, wait a few months, and then do a cash out refinance. That would not be taxable. So that's one way to do it. It does create more debt, but it doesn't create a tax trigger event. And special tax planning. So this is the last slide. I'm going to go through this real quick with an example. This is combining the 1031 exchange with the 121 exclusion. I love this strategy because it applies to a lot of people where they have highly appreciated residences they live in as their home. And then from there, we got a lot of questions we're going to follow up with. So for those who can stay on the line because we're right at the 1 o'clock mark, we'll keep going and answering the questions that were on the pre-webinar list and also those that are still posting questions. So with this slide, let me use an example. We had an actual client here in Southern California. They bought a single-family house or residence in La Jolla, California, husband and wife. They lived there for 42-plus years. They were having health problems at that point. They wanted to sell, go back east and live with their kids and grandkids. The problem is their capital gain after 42 years was $8 million. If they sold the house, they had lived there for obviously 42 years, they qualify for the $500,000 tax-free exclusion. That's the 121 exclusion. But they would have paid tax on the other $7.5 million of capital gain. So they kept telling people, we're not going to sell, we can't do it, we get killed in taxes. The IRS actually has a ruling out where you can move out of the house. That's the downside, you have to move out of the house. But in their case, they wanted to. So they moved out of the house. They went back east with their family. You convert your primary residence into rental property. So we recommended they rent the property for 24 months. That's 2 years, straddles 3 tax returns, really solid proof that your intent was to convert to rental property. And then from there, they kicked the tenant out and they sold the property, and now they qualify for both. They can still say they lived in the property for 2 out of the last 5 years, so they got the $500,000 in tax-free income. And they can also say the property has now been a rental property for the last 2 years before the sale, so they qualify for a 1031 exchange. So they were able to sell the house, they got $500,000 in gain tax-free, and they deferred the other $7.5 million in gain through a 1031 exchange. So the key here is, when you move out of the house and convert it to a rental property, that triggers a 3-year window in which you have to rent it to prove you had the intent to convert to rental, and then sell it and close before the end of that 3-year window in order to take advantage of both. The downside is if something happens and you don't sell within the 3-year window, you would lose the $500,000 tax-free exclusion, but you would still be able to do a 1031 exchange transaction. So that just kind of gives you a rough idea of how you can combine a 1031 with a 121. We can certainly talk more about that later if you have specific transactions or structures you might want to run past us, et cetera. With that, I'm going to quickly wrap it up, but I'm not going to jump off the phone. I'm going to answer a bunch of questions people have pending. So if you have follow-up questions, et cetera, feel free to reach out to our team. We're always available to brainstorm with you. We're more advisory and consultative than most of our competitors, so we'd be happy to chat. There will be a follow-up survey at the end of the webinar, so we'd really appreciate if you can take that, just 4 or 5 questions. Let us know how we did, how we can improve it. You will be able to get a copy of the PowerPoint like I indicated before. There should also be a download for a guide to 1031 exchanges. If for some reason you can't download those two, just let us know. We can email it out to you. And we are recording this webinar, so we can easily give you a copy if you want to listen to it again. I don't know if you want to suffer through me twice in a row, but if you want to do that, you're welcome to do that. So thank you for your participation. And here's our contact information for the regional offices if you have follow-up questions. With that, I'm going to really jump into all the questions we have outstanding. Let me start from the bottom up. It'll be easier for me to click these things up. Does this qualify for CEP? Oh, this question is asking if this webinar qualifies for CPE or CLE credit. No, unfortunately, the webinar is not accredited for continuing education credit, so that's not available. Next question is net proceeds after fees. I think this, not sure what the question, Sam, if you could follow up with a follow-up question there so I know what your question is. I'm not quite sure what you're talking about net proceeds. I think what you're asking is when you, in fact, let me address that. That's a good point. And tell me if this is not what you were asking. When you're selling your relinquished property, you're going to have a gross sale price, what you sold the property for. You're allowed to subtract certain routine selling expenses. So not everything on your closing statement, only the routine selling expenses. So there's really 3 buckets on a closing statement, if you will. There's your routine selling expenses. Those are broker's commission, title insurance, escrow fees, closing attorney fees, CPA fees if they're directly related to the sale of the property, recording fees, documentary transfer tax, things like that. Those are permissible exchange expenses. Those will be subtracted to calculate your net sale price. That's not your net proceeds, that's your net sale price. That's the amount you'd reinvest. On $1 million sale, once you subtract those, your net sale price is probably about $950,000-ish. You do not subtract your mortgage. That's debt. That's not a closing cost or anything like that. The second bucket is going to be, got you. So he clarified the question is, what do you mean by net proceeds? So the second bucket is going to be routine financing costs. So if there's any lender payoff fees, those are not permissible expenses. Those are not subtracted to calculate the net sale price. You also do not subtract your mortgage payoff to calculate your net sale price. That's just your sale price. The third bucket is operating expenses. Anything that would be prorated rents, prorated property taxes, HO fees, those are rental property expenses. They're not selling costs. So those are not permissible expenses. You could have the exchange proceeds pay for anything in bucket 2 or bucket 3, but it would trigger taxable boo. You'll pay a little bit of tax on that. So some investors like to add those items up and then put in out-of-pocket funds into the closing to cover bucket 2 and bucket 3, and then they're not taxable. So Sam, going back to your question, net proceeds would be your gross sale price minus your closing costs minus the loan payoff. So once you sell, you pay all closing expenses and you pay off your mortgage, if any. then that would result in the net proceeds. And the net proceeds is the cash left over after the closing occurs, and that's the amount that will be wire transferred to us as the qualified intermediary. And the net proceeds will be the amount that you would reinvest in your replacement property. Next question is, how do you hide the fact of 1031 from acquisition owner if you need funding from Exeter and a statement showing financial strength? Good question. That's always a challenge. It's pretty difficult to hide the fact that you're doing a 1031 exchange. We can always prepare our documents at the very last minute so that you don't have to disclose it at least up front. But at some point, the purchase and sale agreement has to be assigned to us in order to count as part of your 1031 exchange. At some point, the lender on the buyer's side, which in this case would be you, and the replacement property, is, if there's a lender, is going to want to see all the transaction documents. So at some point, they're going to find out it's a 1031 exchange. If they want a verification of funds, we can certainly provide that, but it's going to be in our letterhead. So it'll be obvious that it's a 1031 exchange transaction. So you could hide it up to a certain point. Excuse me. See, next question. Do we have any referrals for real estate brokers who are experienced with 1031 exchanges? Yes, it depends on the geographic area. If you let us know what type of properties you're interested in, the asset class, is it office, is it residential, is it retail, apartments, etc., and the geographic area, we can see if we have anybody to refer you to. If we don't really know the person, we're not going to refer them. So it's only somebody we've worked with quite a bit that we're comfortable with. So it depends on the area. Next question, does the offer have to be made in your name? What about the fact that title has to be in the name of the irrevocable trust? Good question. If you're selling relinquished property through an irrevocable trust, you have to buy in the irrevocable trust in most cases. You could probably make the offer in your individual name, but you want to add N or assignees because when you close, the irrevocable trust would have to acquire the property. Same with reverse exchanges and improvement exchanges. When you're making offers, you can always make offers in your name, but you'd want to add N or assignees. And in those cases, I'd absolutely add language in the agreement that seller agrees to cooperate at no additional cost or liability with buyer's intended reverse 1031 exchange, et cetera, by, and then we define what they're agreeing to cooperate with, just to make sure they can't renege on it. Next question. Do I have to buy the property that I identified in 45 days or buy a different property? You would have to acquire something on your identification list. So once the 45-day period passes, you're stuck with what you've identified, and that's what you have to acquire. So you can change your mind anytime during the 45-day period, but you can't change your mind after the 45-day period. Next question, page 24 of the PowerPoint talks about tax return due date impacting the 180-day limit. Good question. Yes, let me see if I can back up there real quick. There's the slide that we're talking about there. So the deadline is actually the earlier of 180 calendar days or the due date of your federal tax return. There's an easy workaround, and that is file for an extension of time to file your taxes. Finish your 1031 exchange first after that, and then file your actual tax return. So you'll always have the full 180 days as long as you file an extension of time for your tax return. That only affects exchanges where the relinquished property sells between October 17th and December 31st, because that means that exchange is going to land, the 180-day period would land after April 15th for most taxpayers. So good question. Thank you for catching that. I missed that one. Next question. Unfamiliar with all those rights and interests. Are those attractive to buyers for capital appreciation potential, and where fall in the risk spectrum? So I think you're talking about mineral rights and water rights and air rights, et cetera. Those are very specific types of investments. So generally, unless you really know what those are and how they work and how they go up in value, how they go down in value, I wouldn't touch them. I know enough to talk about them, but I'm not an expert in those areas. So personally, I would never buy any of those because I just don't have enough information to really understand what I'm doing. I only buy what I really understand. And I think that's most of the list that people were typing in. So let me go through our list that was submitted prior to the webinar. One question was, when a condo is sold, can a house and lot next door qualify for the 1031 exchange? Yes, as long as the condo and the house next door are both rental, investment, etc., that would qualify. If I do a 1031 exchange and then sell my new property, do I pay capital gains, and the calculation is on both properties? So yes, let's say you've been 1031 exchanging over and over and over throughout your lifetime, and then you get to a point where you decide, I'm done, I'm just going to sell, I'm going to cash out and pay the tax. You're going to trigger and pay the tax on all of the accumulated capital gain taxes and all of the accumulated depreciation recapture taxes. The only time that answer would be different is if you're in, say, the middle of a recession and the value of your property drops so much that it wipes out all of your gain. But otherwise, yes, you're going to pay all the accumulated taxes. Can we roll a replacement property investment into a subsequent 1031 exchange? Yes. So if you sell, you do an exchange, you buy a replacement property, and then later you decide to sell that, you can do another exchange over and over. So that certainly works. Let's see. One question was, if we acquire a property that's less than what we sold, we covered that. So that would be a trading down or partial exchange. It would be partially taxable. There was a question, how to convert your 1031 exchange property into personal residence. We covered that. There's a question on, what if we sell property and do a seller carryback note? So let me quickly talk about that. You could certainly do a 1031 exchange when there's a seller carryback note involved, but it does complicate the 1031 exchange. So for example, you're selling $1 million property and the buyer says, look, I'm having trouble getting financing. Would you do a $200,000 seller carryback? And if you say, sure, I'll help you out. What you're getting at the close of the transaction is $800,000 in cash and $200,000 in a promissory note. The challenge is the promissory note could be drafted in the name of us, Exeter 1031 Exchange Services as qualified intermediary for Jane Doe. That means inside your 1031 exchange, we are now holding cash and a note for you. That's the easy part. The tough part is when you go to buy replacement property, how do you buy replacement property when 20% of your proceeds is in the form of a promissory note? So you have really three options. One is if you have enough cash in your own pocket, you could put $200,000 into the closing or into the exchange account and fund it for yourself out of personal funds. Most people don't have a lot of cash laying around like that. You could sell the note to anybody, a related party, a non-related party, but usually any buyer for a note is going to want to discount it pretty substantially. So you're going to take a hit, but you could certainly sell the note. That would be an option. That way you've converted it to cash. Or if you find a seller of a replacement property that's willing to take that promissory note as part of the payment, you could certainly do that. We'd assign the note to the seller of your replacement property. That could work. I can tell you probably about 85% of seller carryback notes don't work out the way you had planned. So be very careful with seller carryback notes. Let's see, I'm going through real quick. We've covered a lot of these already. Somebody asked about what kind of language should go into the sales contract. We briefly touched that. You don't have to put any language in the contract regarding a 1031 exchange, contrary to what you hear out there. But in a lot of cases, for other reasons, it might be recommended to do so. So it really depends on you, your transaction, where you're located, whether there's any local requirements to disclose it, etc. But if there's nothing in your contract about a 1031 exchange, that will not hurt the 1031 exchange. There may be other reasons you need to do it, but it won't hurt the 1031 exchange. One of the questions, does Exeter provide funds for deposit? I think what they mean is, do we provide a letter? We could provide verification of deposit or verification of proceeds. So if a seller of replacement property want proof that we're holding cash on your behalf, we could absolutely do that. Here's a question we didn't answer, which is, what happens when the person who starts a 1031 exchange dies? So that one depends on where you're at in the process. So let's assume we have the sale of relinquished property. We're starting the sale. The sale has not closed yet, and the seller dies. At that point, the seller still owns the real property. So the seller would probably get a step up in cost basis because they died while they still owned the property. They probably would not have to even worry about doing a 1031 exchange. They should consult with their accountant to verify that and make sure, but they probably wouldn't have to do it. If the sale occurred and closed and we're holding the proceeds in a 1031 exchange and then the exchangor passed on, at that point you have to complete the 1031 exchange in order to defer the tax in most cases. It's possible they can get a step up in cost basis, but it's usually only if you complete the exchange, you buy the replacement property, then you get a step up on the replacement property. If you don't finish the exchange, it will be taxable at that point. We've got a couple of questions about timing. Seems like it's difficult. Can you buy first? Is there a way to get around it? Yes, that's the reverse exchange, which we talked about. Another person asked if the exchanger wants to sell the replacement property, presumably someday in the future or something, is there any interest for the accumulated income taxes? No, as long as you've been deferring all along, you only owe the tax once you sell and quote unquote cash out, and there's no interest due at that point. So it's kind of an interest-free loan when you think about it from the IRS's perspective. Let's see. We covered partnership issues. So again, if you've got any kind of entity or partnership issues, feel free to call us. We can dive into your specific details. There's one question here that we've answered, but I wanted to expand on it a little bit. And it was about selling California real estate and exchanging into another state. Excuse me. And that's the California clawback. So for those of you who own California real estate, California takes the position that if you sell California real estate, you do a 1031 exchange and you buy replacement property in a different state, it is tax deferred because you did do a 1031 exchange, but you now have to report to California every year on the status of that property. As long as you still own it, or you continue to do 1031 exchanges, or you pass on and get the step up in cost basis, you'll never pay California taxes. But if you ever sell and cash out in the future, California wants their quote-unquote fair share. So we nickname that the California clawback provision because they reach out into the other states and claw back part of the income tax or income taxable gain in the form of California income taxes. So just kind of keep that in mind if you're selling in California going out of state. And I think as we go through it, we've answered all the other questions. There's some more up on the board. I'll grab it. If there's any follow-up questions that I didn't answer or any additional questions, go ahead and post those now. We'll go ahead and take them. Question is, if the sale on the old property has not closed, can I personally fund the escrow? And I'm not sure if that is talking about like a seller carryback note. I assume that's a seller carryback. So if that's not what you meant, post a follow-up question for me. But if you're selling relinquished property and you're going to do a seller carryback note, yes, you can absolutely put personal funds into the escrow. You're effectively acting like the lender. You're putting money in, and then the note, the promissory note, the seller carryback note would be drafted in your name effectively as the lender and would not be in our name as the qualified intermediary. And then when the closing occurs, we would receive all cash. So in a perfect world, for a seller carryback note, that's exactly how you would deal with it. And that's what I would highly recommend if you're in a position to do that. Next question, any other good seminars by Exeter? We do a webinar or seminars all the time. We're probably doing 3 or 4 seminars every week in different locations throughout the country. You could go to our website, and we've got a seminar page. Anything that we do that's open to the public, we would post out there, and almost all of them are free of charge. The webinars we typically do once a month, and those are all free of charge. Speaking of that, we are going to be rolling out additional products and services under the Trust Company brand. So the fourth quarter of this year, we'll roll out self-directed IRAs where the investor can invest in real estate. We'll be rolling out either fourth quarter or maybe early next year, title holding trust or land trusts for very specific needs. And we could do specialized holding escrows. And we'll be doing webinars and seminars on those topics as well. So you can check our website for anything that's coming up on that. Next question was, what type of account do you hold the 1031 exchange funds in, and do I get interest during the 180-day period? Good question. So it's my favorite answer. Again, it depends. We do not invest the funds in anything funny, fancy, or risky. So like some exchange companies may invest in stocks, bonds, mutual funds, etc. We do not. We just use plain vanilla commercial banks. So nothing exciting. So the interest rates, especially today, are horrible, but we do invest them in just a regular money market account at commercial banks. If the account is holding cash of $1 million or greater, then we share the interest with the investor, and the interest depends on the interest rate the bank's paying at that point in time. The Federal Reserve just dropped rates by 25 basis points, and they're expected to do that 2 more times this year. So it'll depend on when you're doing your exchange as to what the interest is. If the cash position is less than $1 million, then we keep all the interest as our fee, since it's such a small percentage right today. The interest is part of the fee that most qualified intermediaries charge to help compensate for the services rendered. Okay, next question is, will you discuss 453? Client has gain of $1.3 million, getting $900,000 mortgage, is 90 years old. So Section 453 is the installment sale code. That means they're selling property and you've got choices. One choice is you sell the property and you don't do an exchange, you do a seller carryback note. So you say, look, we're going to sell this property, we want $300,000, or let's see, I guess it's $400,000 cash down and a mortgage of $900,000. Well, the $900,000 is the seller carryback note, and that would defer some of the taxable gain over the period of that note, whether it's a 5-year note, a 10-year note, etc. In this case, it looks like the taxpayer is 90 years old. So at that point, I'd probably shy away from a seller carryback note, because a seller carryback note means that you have triggered your taxable gain. You're deferring it over the term of the note, but it is triggered. And then at some point, all of those taxes would be paid. If you did something like a 1031 exchange or a 1033 exchange, then all of the taxes would be deferred. And then at some point in the future, hope it's a long distance future, but at some point in the future when you pass on, you're going to get a full step up in cost basis and all the taxes completely go away. So I'd probably look at a 1031 exchange. If you're trying to get rid of the property management headaches, I'd probably look at a Delaware statutory trust, just so you don't trigger the gain, you can defer it. So that would be probably my best suggestion at that point. Any other questions that we can answer for you? Okay, it looks like that's it. So we're going to go ahead and wrap up the webinar today. Thank you so much for jumping on board with us today, and we look forward to working with you. Please feel free to reach out and ask any questions you might have. We're always available to brainstorm for you. Thanks so much. Have a great day. Take care. Bye-bye.